Happy New Year and welcome back to Beyond the Sign. This is our first episode of 2026, and we're excited to kick things off with a great conversation. Today, we're joined by Brock Baker with Inspired Advisors. I'm Landon, and as always, joined by my partner, team lead, and owner of the Sears Group, Martin Sears. A lot of our listeners own real estate, they run businesses, and are trying to make sense of investing, retirement planning, and long-term decisions, how they actually fit together. Brock works with people in the exact position, helping them bring clarity to their money instead of just chasing returns or open random accounts. We're going to talk about how he helps clients think through their finances, how real estate fits into a broader plan, and why investing is often more intentional than people realize. So, Brock, it's great to have you on.
Yeah, thanks for the chance to be here, Landon.
Absolutely. We're glad you chose to join us this morning. We have a lot of questions, and I have a lot of questions specifically. So, I kind of want to dive right into what you do for people who are hearing your name for the first time. How do you usually explain what you do and how you help?
Yeah, well, the common term is financial advisor that you hear. What I really do has a lot to do with financial planning and investing. My key clients or the normal base of clients are people preparing for retirement or that are already retired and or even more specifically recently retired as they sort of navigate what the retirement years look like. A lot of people don't think about it as they're sticking money in their 401k or whatever about the true cost of retirement. It's by far the biggest purchase in air quotes that someone's going to make in their life. If a person retires at age 65, let's say, and has a 25-year retirement till their age 90 and pass away. If they take $10,000 a month, say that's, their income or what they need for their expenses, $10,000 a month for retirement, adjusted for inflation, at the end of 25 years, that's $4.66 million that they'd need to fund retirement. Most people don't have that right now, or, most people don't start off with that. So there's a lot of components. And I should say of that 4.66, nearly 600,000 of it is taxes that would be paid. And that's using a 12% tax bracket, which is a lower tax bracket. I don't anticipate them staying that low. And many people are going to be in higher tax brackets, which is going to drive that up even more. So helping people say, okay, maybe they have $500,000 in their 401k now, and they're looking at retirement. How do you jump that hurdle to a cost of 4.6 million to keep living the lifestyle that you're living? And so it's really meeting with people and begin putting lots of pieces in place. Tax strategy is a big part of it to figure out what things can we do to reduce those taxes throughout the years. There are other things like, how do we keep your Medicare from jumping up? How do we reduce the taxes on Social Security in your retirement and those sort of things? But investments are a big piece. I talk to a lot of people that say, we have $1 million now and we're very conservative. We really don't want to lose money. And I usually tell people, I haven't really worked with too many clients that do want to lose money. So you're in a good mix. So being uber conservative is what they want, but that's going to be also hard if you're extremely conservative, just making savings interest. Say, how do you reach that 4.6 million by the end of 25 years that's going to cost you for retirement? So there's an element of figuring out how can we get good returns and yet keep your money relatively safe during that time period. And so those are all sort of things that go into to working with clients. I mean, some of the specific stuff I love is getting into, if they're generous people that give to charities, there's some pretty cool tax strategies that we can use to really reduce that tax load in retirement. But yeah, really it's helping people put together a strategic plan of how can we retire and live the way we want to in retirement, and reach the end with money in our accounts that maybe we can still pass on to our kids or our heirs.
And Martin, as a senior real estate specialist, I want to let you kind of elaborate on this. I know we both work with clients, but how many of those, when you're sitting at the table with those retired couples, and how many are really truly prepared for retirement, or they're, possibly selling because that is their retirement at that point?
Yeah, you probably know this, that, our average client, we're senior real estate specialists. So a lot of the advertisement and a lot of the clients that we receive are in their golden years. They're 65 and older. I would say probably 60 or 70% of those people. So they've already been in a situation where they already have a portfolio manager like Brock. But keep in mind that we always try to elaborate that we are also, we're dealing with one of the largest assets of their life, right? So if they have a $500,000 house or a $400,000 house, we need to talk about capital gains. We need to talk about where they're going, what they're doing. There's a lot of aspects in what we do rather than just drive around showing properties. And majority of the Sears group, we are more or less listing agents, and we do specialize in niche properties like the active adult community. So we're quite diversified with that, and we can relate to everything that Brock is saying. It all comes full circle. We always ask clients when we're at an interview to please check with your portfolio manager what you're going to do with your assets, where should you put your trust money, things of that nature, just so they can maybe protect their interests.
And Brock, what pulled you into this line of work? I mean, where did it all start?
Yeah, yeah. Well, I mean, I love business. It started off like in corporate business world, and my passion, my degrees in my MBA is in international business, and but in business roles, finance has always been my favorite part. I mean, that's what sort of gets me excited is financial planning, budgeting, that sort of stuff. And then I spent a period of time in the nonprofit world, leading a nonprofit, and then the third part of life doing personal finance and helping individuals with all the things we talked about earlier, putting all the right pieces in place. And for me, what I really love, and my favorite thing about the job is when clients talk about, I sleep better at night. It's been such a huge blessing, such a load off to have someone that's has their eye on these things and that has given us some assurance that we've got a plan, we're moving the right direction rather than just guessing or just throwing arrows at the board and hoping they hit the right place.
And Martin, from your perspective as an owner and investor, what are you looking for in an advisor partner beyond credentials or returns?
Transparency, really asking more questions. I think that's the most things that our audience should really understand is with so much information out there, ask your advisor questions. Ask anybody that has to do with financing, service oriented industries. Ask more questions. We need to understand where our money's going, how money works for you. How much just like we charge a fee, how much do the professionals charge on fees as well? So those are the type of things that I would certainly ask. I know I ask my portfolio managers that. Here's what I can tell the audience. I'm different, right? So I'm 52 years old, so I'm gearing up for retirement. Brock, it sounds like from your intro that you're dealing with more or less your demographic is probably in their late 50s, early 60s. So they're kind of already in the 80 percentile. They're on coast mode. Is that probably safe to
Yeah,
say?
I would say really it's probably people in their 50s that, the 10, 15-year lead up to retirement, because that's where you can make probably more important adjustments. But then as they hit retirement also, there's a lot of, things to be looking at.
So I'm in growth mode, right? So people in their 40s and 50s, we need to just buckle down and be in growth mode. Everything that I do is, and we put a lot of money into the markets. I mean, markets are awesome. Understanding the difference between real estate and the real estate or the financial markets, it's so important to be diversified. But to answer your question, Landon, I'm in growth mode. My wife and I put you're supposed to put 15% in. We do double that if we can afford it. We try to put as much as we can into the markets just because we understand how the S&P 500s and how the average returns come back around. There's no other instrument that can outbeat the stock market. Now there are areas of appreciation in real estate, and this is a real estate show, and we're here to bring hope. It's another diversification of how you can make money, but I'm a true believer of the stock market, and I wish I would have started a lot earlier. That's the advice I could give people.
Right on. And I want to hit one question that I think a lot of people have, including myself and others out there who are trying to maybe explain this to their loved ones or friends, is that a lot of people listening probably think I have a 401k with my employer and I'm contributing. Why do I need to do anything beyond that? How do you usually answer that question?
Yeah, well, it's a good question. One of the things, we were contributing to a 401k, maxing out an employer match, I tell people is objective number one. So list all the list of things you should do. Take advantage of your employer's match. In most cases, you're doubling your money the moment you put it in. That's hard to beat. So it is a key component. But the best retirement plans, as I've been working with people, and they come from all different walks of life. The best looking plans are people that have diversification in their retirement income, and that's where real estate comes in. I mean, I have a lot of clients that have rental properties that you start factoring that into, again, say we're going for that net of $10,000 a month. If they've got a rental property that's bringing in $2,500 a month, just takes the pressure off everything else. Well, we need to pull out of investments, then you add in Social Security or things like that. It starts bringing it down and starts reducing that pressure on the portfolio and what sort of returns we need to get. Also pensions, people that have pensions, it's usually government workers, for military. I mean, those are a huge benefit also in retirement planning. Or businesses is another thing. People that have a business that they still have a hand in, so there's still money coming in from that. Those sort of things can be a big benefit to a retirement plan rather than leaning 100% on your 401k. Because the reality is, in every 15 years or so, we go through a major market drop historically of 30, 40, 50% drop in the market. So if everything's in your 401k, and your $2 million retirement right as you're ready to pull the trigger drops down to 1.2 million, in the 2 years leading up to it, that's a pretty scary thing. And if a part of it's made up of a rental house or two or that sort of thing, I mean, it really helps to stabilize that picture and reduce that reliance solely on the stock market. So, I think diversification is a huge reason not to just count on your 401k is the only way to retire.
So that's cool. And I love this conversation because when those dips happen, and if one of your clients has real estate for diversification and they have equity, they have a ton of equity, that's exactly when they should sell their real estate and then give you the money on those dips to go back up.
Yeah, 100%. Yeah, you're right.
So that's huge. I mean, people who have wealth and have diversification with real estate, if they're paying attention to both of those syndicators, one is going to correct itself, just like real estate corrects itself. We're going through a small correction right now in the Phoenix market. There's pockets of us in the West Valley that are down 9 and 11% just this year. This is not the time to sell. This is the time to buy. If the stock market or the S&P goes down 20 or 30%, and it's 2029, and we've already gone up 30% appreciation from 2026, which is very highly likely, sell your house and give your money to Brock. Play both sides of it.
Right.
Play both sides of
That's
it.
true. Yeah. So, Brock, insurance is one of those topics people avoid or overcomplicate. How do you decide when life insurance and risk protection are important, and how should they fit in someone's overall plan?
Yeah, good question, Landon. I think as families are in there, especially in the growth mode, like Martin talked about, and you're making a good income and contributing as much as you can. I mean, it's super important that there's life insurance, on both the husband and wife, especially when kids are involved. Things like that can just obviously rock a financial plan. I mean, not only does it rock their lives if someone passes away, but you don't want to destroy the financial plan of your spouse and children at the same time. And so I think having the right amount of life insurance, they talk about the Wall Street rule of thumb is 10 years of income, that you have 10 years of income plus your debts in life insurance and a life insurance payout, sort of to protect the family. Beyond that, I think long-term care is a whole nother issue. I mean, long-term care insurance is an interesting topic because a lot of people have strong feelings. I mean, it's expensive. Long-term care insurance can get expensive, but there are ways of building different types of policies that could make sense. The biggest policy people have when it comes to long-term care is hope. They hope they'll never need it, but there's a large percentage of people that once they reach age 85 need long-term care. I mean, very large percentage. And so having some sort of plan in place, and Martin, to the real estate side of things, I talk to people all the time that tell me our plan is we'll sell the rental in Colorado if if we hit a long-term care. And that's fantastic. That's because that's a plan. Like, to have a plan aside from just hope is the important thing. It may not be insurance, but those are things that we look at. I mean, disability income's another one. Someone that has, I just met with someone recently, very high income earner, young family guy, and talking to him about disability income insurance is an important thing, because what happens if he hits some stage in life, a car accident, whatever, where he can't work for 2 years? What does that do to your family financial plan? Is there something to protect that income if something happens to him? They're not necessarily fun things, because nobody likes writing a check. For us old people that used to write checks, but nobody likes making a monthly payment to an insurance policy that they hope they'll never need. But it is important in people's financial plans to make sure that they're not vulnerable to all these risks that could happen and destroy. Not, like I said, not just for them, but for their whole family, their spouse and family's financial plan. So it's an important thing to look at.
All fathers, all husbands need to have life insurance. They just do. It's your responsibility, guys out there. If you're married, you have minors, you're not in retirement stage, you have you have to do this. It's your responsibility to your spouse, to your family, to your children. You just got to do it.
There's a simple answer.
Yes, for sure. And Martin, I was going to ask you, and I think you just answered it, but if you want to elaborate on, from an ownership standpoint, where do you see people underestimate risk or protection when things are going well?
Well, the second part of that question is something I would like to speak to, I guess, and I hate to ask a question with a question, but I'm going to bring Brock in on this. There seems to be a craze of what's happening. The dynamics have changed how people and young people are investing, from what I see. And this is just from social media, from listening to other financial podcasts. I don't know if Landon told you, Brock, but really what our mission, what we do with our podcast, is a real estate show. Yes, it is. But when we've sat down and tried to figure this out, we want to bring hope, right? So if we can have guests on here that talk about financing, talk about assets, bringing hope. That's not the whole grand scheme of hope, right? There has a lot of faith that goes along with that as well. But it sure comes in handy down here. You know what I'm saying? So, so with that said, I'm seeing a lot of craze with people that are doing these stock flipping, and I'm guilty of it as well. During COVID with IPOs and stuff. Of course, it's fun. It's gambling. It's action if you're into that. But I personally feel at 52, and I wish I could tell myself, my 40-year-old self, if I could tell you, Landon, in your age, compound interest is the eighth wonder of the world. Stop
Yeah.
flipping good companies and let it ride and forget about it. Would you agree on that, Brock?
Yeah, I mean, like you said, the power of compounding interest is amazing. Um, yeah, I read a book that talked about a story comparing two 26-year-old, or I think no, I guess it's 21-year-old girls, that one of them saved $2,000 a year until she was age 26 into a retirement account, then left it until she was age 60, I think, or 65. And the other girl waited until she was 26, and then she invested $2,000 a year for the rest of her life until she was age 65 to retire. So one girl did it for 7 years or 6 years until she's age 26. The one did it beyond that for the rest of her life. At age 65, using 10% interest, which is what the stock market's returned over the past 100 years, using 10% interest at age 65, the first girl had more money than the girl who contributed after age 26 for the next 40 years or 39 years or whatever of her life.
Wow.
That's the power of getting the ball going and compounding and growing. So yeah, getting in early is a super important thing. The other thing you touched on a little bit, Martin, in types of investments that I'd say is I often get asked about, and maybe it's something you're going to ask about, but gold and crypto, those things people ask about often, and compared to stocks. And I guess maybe I'm a little old fashioned. I mean, people have made a lot of money on crypto and gold recently. I mean, gold since COVID has been amazing. The difference is when you buy a stock, you're buying a sliver of a company. You're owning a company. So you see this company that's on the right path and growing, and you buy a sliver of that company. They keep growing, they expand, they add stores, whatever things, in 10 years, it makes sense that you've owned a sliver of that company. It's bigger now because they've grown, they've produced more profits. When you buy crypto or buy gold, you're buying it under the hope that someone will give you more money down the road for that same piece of gold or that same crypto back at the end of the time. It's not making anything, it's not producing anything, like gold. It's a hedge to at least make sure you hopefully get back what you put into it. But that's the value in the stock market is picking companies that are growing, producing profit. And so you buy a company that's this big, you sell it, and when it's this big, your sliver just got a lot bigger because that company's growing. So that's, I think, being invested in good companies is another important part of that puzzle.
That leads right into our next section. And I guess I'll just leave it to you. Your company is a bit unique than every other financial or advisory firm out there. So tell us a little bit about Inspire Advisors and what you guys do as a company.
Yeah. Okay. So at Inspire, so what makes us unique, I guess, in the investment world is that we believe that people can invest according to their values. It really seems like over the past 5 years, a lot of corporate America has got very involved in politics and pushing their worldview on people. And I used to be with the firm I was with before this. I had quite a number of clients say, "Hey, I went out of this company. They're doing this. I went out of this company. They're doing that." And really, most of the investment world isn't set up to do that. I mean, you invest in these index funds, you invest in whatever mutual funds out there, and a mutual fund maybe contains 500 companies or whatever. You're getting a tiny sliver of all those companies. But as people begin to say, "Hey, I want to make my investments align with what I believe in. I don't want to be involved in," like, there's Rick's Cabaret is a publicly traded company. They run strip clubs around the United States, and so they're in a lot of portfolios. I just was looking yesterday. I was helping a young man look at his portfolio, and he has very, very conservative Christian values inside his portfolio. He owns shares of this Rick's Cabaret and Playboy inside his portfolio, and much to his disappointment. So we help people look in their portfolio to see what they're invested in, and then shift those investments to align really with conservative Christian values. If companies are producing an abortion drug, we're not going to invest in them. If companies are distributing pornography, we're not going to invest in them. There are a number of screens like that we provide to our clients to help them invest according to Christian conservative values. And it's amazing to see the increasing demand for that. Like I said, as our culture just really splits, and a lot of these companies are shifting from just doing good business to really advocating for their ethical beliefs, which really run opposite of a big portion of our country. So that's what we do, is help people look through their investments, see what they're invested in, and get invested in things that align with their values and don't go against everything they believe in.
Let me play devil's advocate for a second. And I'm sure people say this, and if someone says, I don't agree with everything that the companies do, but I do prioritize maximizing returns for my family, what is the real downside in that mindset, if any? And in your experience, is there actually a trade-off between caring about alignment and achieving strong long-term goals, or is that mostly an assumption people make?
Yeah, good question. So, this is a common thing it's really the next question everyone has as we talk about here's what you're invested in. We run something called an impact report for people. So I'd say if any of your listeners are interested in just finding out what's in it, we run this impact report that shows what your investments are in. And really then question 2, once you show that to people and they're like, okay, I want to make a change. Question 2 in their mind is, what do I have to give up when it comes to returns? Are returns going to suffer because now we're no longer invested in Apple and Amazon, Meta, companies that are screened out for different reasons? Are we still going to get good returns? And the simple answer is yes. There are a ton of great companies out there that it doesn't even mean that they're Christian-run companies. It just means they're companies that stay out of a culture war. They want to make a good product. They want to make profits for their investors. They want to take care of their employees, and that sort of thing. And there are a lot of great companies out there doing that. In fact, I just was looking, one of the investment sites I follow just put out their top 10 picks of 2026, top 10 stocks. I looked at all those stocks. 7 out of the 10 are companies we would invest in. There are only 3 companies we would filter out. And honestly, that even seems high. I feel like when I look at investment recommendations from people, I enter them in to look at what they're invested in. The vast majority of them are companies we can invest in. It's really just that upper crust of companies that feel like they have this social duty to lead this strong, liberal agenda and cram it down people's throats. There really aren't, in the overall scope of the stock market, that many companies that are screened out. And the returns look amazing. I would say in many of the instances when I run this report for people, the identical portfolio, meaning the same amount of technology, the same amount of international, the same amount of large cap, small cap, using all companies that would align with their values. In many cases, the second portfolio would outperform what they currently have. So it doesn't mean that they're leaving behind, the dream of big returns. There are great companies that they could be invested in. And that actually leads to one of the points I make to people, because maybe this is your next question, but people often ask, well, what about as a consumer? I mean, does this mean hypocritical because I have an iPhone, but we can't invest in Apple, or there's lots of things like that people could look at. And I think the difference is, as a consumer, we have to pick what's best for us and works for us and accomplishes our goals and that sort of thing. And in investing, it's somewhat the same. The goal is obviously usually returns from people. And when you have options that align and options that don't align, and they're both good, why wouldn't you pick the options that align with
Right.
what you want to do? And so I think it's a fairly simple choice for people if you're given those options.
Absolutely. I think it seems intentional as well. Like, outside of, morals and just the beliefs that people have, is that it seems like you guys are doing more research behind these companies and would have a better gauge of what to invest in. I mean, it seems that way.
Yeah. One thing, a tool I will throw out to people that are listening or watching is we have a website, inspireinsight.com. It looks essentially like a search engine. You enter in a publicly traded company or their ticker symbol, and it'll show you it'll give you their score and sort of what they're invested in. You can also use this for mutual funds and ETFs, and it looks at everything that's in the ETFs. But it's a good tool for people to look at that want to see what their investments are.
That's neat that you guys provide that service. I'm familiar with a service very similar, like a Morningstar. It's very similar to what you guys are doing. You're grading it on maybe like 5 stars, and maybe like where the hype is and then where the low is. Is that fair? Is that accurate?
Well, the Inspire Insight is, that particular site is only looking at what companies are invested in, not the strength of their investment or their returns or anything like that. So what it's going to say is, I don't know, you enter in eBay into it, and it's going to say, eBay distributes pornography, and this is going to say eBay does. It's going to kind of like run through and tell you what the reasons are why it has a negative score. I mean, first of all, it's going to give you their score. It's going to give you the reasons with links as to why that score is negative. And so it doesn't get into helping you select good investments or that sort of thing. It's just a way to look at a particular company and what they're engaging in and what they're profiting from.
Yeah, the perspective. Okay, well, that's good. Well, that's equally as important if you got morals and values. I mean, we all should have them. So that's a
Right.
good point of view. That's awesome what you guys do. I got to tell you, I've never heard of a company with a moral compass like that looks out for people's interests rather than just. I mean, returns are a part of the whole gig, but if you're going to make 8 and 10% or 15%, you might as well do it for a good cause or a community type of cause rather than just the alternative, what we're discussing. So kudos to you and your company, Brock. That's fantastic.
Yeah. Thank you. Thank you. Yeah. No, I love it. I love the chance to help people accomplish that goal of aligning things. I mean, there are a lot of people that have strong strong stances or strong feelings against abortion, and yet in their portfolio, maybe they have a number of different abortion drugs. So every time a young lady gets an abortion with those drugs, they profit. That doesn't set well with people that that doesn't align with their values. And so this gives people an option to make sure that what they're profiting from is something that they align with.
That's awesome. I really like that, and I think it's very intentional. And I just think that that would reciprocate into the investments as well. Can you remind us of that website one more time? I want to make sure that's linked below in our show here.
Yeah, you bet. www.inspireinsight.com.
Thanks, Brock. A lot of our listeners own real estate or they plan to invest in it. How do you help someone think about their market investments and real estate when real estate is a big part of their overall plan? And what mistakes do you see people focus too heavily on and not the other?
Yeah, back to what we were talking about earlier. I think the big key is diversification. If like you said, if someone says, I've got this, I've got all my money in an IRA or 401k, we talk about diversifying those income streams in retirement. Similarly, if someone says, I've got 15 rentals and that's my retirement plan, I'd talk to them about developing IRA accounts or Roth IRA accounts or something else that gives them other exposure, which the more exposure you have, the more it reduces risk. I mean, it's the biblical concept of diversification, to not have everything in one basket. And so I think that's the overall concept that I'd talk to them about if they were too heavy in real estate or too heavy in the stock market, about how do we balance that out.
Martin, how do you personally think about balance between operating businesses, owning real estate assets, and investing capital? Because I know you do all three of them, and you've owned restaurants and still own restaurants, I believe. And how do you manage all that and where you should be putting your funds?
For the record, I do not own any more in the non-food industry. That was
Okay.
25 years ago. I was in a franchise back east. But you have got to, if you understand the fundamentals of compound and wealth, and someday you want to retire, you have to be diversified. You need to read. You need to understand. Putting your head in the sand is not what you should do. You should really try to understand where your money is going. You have to have real estate. I mean, I look at real estate's vital, right? You got to have a place to live. But also, I think you should be diversified with some rentals. You just should, and understand the dynamic of supply and demand with housing, with stocks, with a sector. You just need to do it. So the audience, I know you keep hearing this word called diversification, but it needs to be a key concept. You need to think about that every single day. Everybody, and also you need to budget. Husbands and wife, you need to sit down once a month on a Sunday and you need to sit down and go over a budget. You just need to do that. I don't care if you're retired. I don't care if you're 25 years old. You need to sit down and go over a budget so you can allocate funds. We're going to give Brock 15%. We're going to put 15% towards our principal and interest on our house so we can buy down the mortgage. We can buy down the principal. We can buy down the interest, whatever the case may be. We can take that money. Interest rates are low. Now that we've got all this equity, because we've taken that 15% off our mortgage, we can buy a rental property and we can have passive income coming from that revenue stream. You can take a 30-year mortgage by making one house payment a year down to 23 and a half years. I think that's the equation, 22 or 23 years. That doesn't sound like a lot, but it's a lot. You do that times 3 or 4 in your lifetime, you're sitting on $1 million, if not more. It's just start young and smarten up. And not only that, and Brock, this drives me nuts because I'm guilty of it when I was younger, but just the whole budget point of it. And I'm not going to throw off on people's lifestyle. I mean, crutch, and everyone has some people play $200 round of golf, a $10 coffee. But think about that for a minute. I mean, you want to have fun. Life is fun. You're supposed to have fun, but my goodness gracious, if you do a $10 coffee every single day,
Yeah.
instead of doing a $2 coffee or a 99-cent coffee or going to the store and making coffee, I mean, man, that's $520 you could give to a Brock. at the age of 25, compound interest, he's going to turn that into, $50,000. I don't know. I don't have the amortization on that, but just if you think like that, it will come. You have got to get frugal and you have got to start thinking about that diversification at a young, young, young age. And honestly, it's never too old to start. I listened to and I keep talking about young, but there was a CNBC interview with Warren Buffett. He just gave up Berkshire at the end of the last year, like last week, and he's not the shot caller anymore. I believe it's his. I don't know if it's son or not, but anyways, if you look when you listen to his bio, he really didn't start making big money until he was in his 50s, right? He didn't start making the big, big, big money until he was 55, 57, 58. And then he was like, wow, this is really, everything's paid off now. And I'm starting to see all these returns. And I got a quick story. One of my very first employers that I worked for in the housing industry, his name was Jerry. And he's a big inspiration in my life. And what he did, his story is so, so, so neat. He started buying manufactured home communities and rental dwellings and commercial dwellings, multi-residential, right out of college. He had a bunch of investors. They were over leveraged. They were poor. They lived in a manufactured home and they were basically government cheese, government butter. Kids went, they purchased their clothes from secondhand stores, got help where they could, and just worked odd jobs, worked 7 days a week. All of a sudden, when all the stuff was paid off when he was in his 50s, he became an overnight millionaire. Overnight, he went from literally poverty, where his car was busted up and rust all over it, and he had secondhand clothes, to that whole mindset. Listening to him, we should have him on a podcast sometimes. It took him 5 or 6 years to get through that whole mindset, or just that lifestyle of, I don't have to eat ramen noodles tonight. I can go get filet if I want to, or whatever the case may be. It happens fast if you're smart about it and you're determined and you're really disciplined.
Yeah, speak to that on the topic of discipline. That's one of the things I often tell people is all the different factors you can look at. Like, what are the people that are going to wind up with a large retirement, account that have the millions at the end, and it's a habit of saving above all else, more than what they're investing in. Whether they're investing in real estate, investing in stock market, more than what they're investing in. It's a habit of a lifetime of saving, like you said, carving out that 15, 10, 20% each month that you're saving, setting aside. And it's just a continual thing. That's the great thing about 401ks is they take it out of your check and you don't even have to think about it. The people don't have access to that money because it's taken out first. But I talk with people that say, well, I'm trying to build up this business because then I'm going to sell it for millions and that's going to fund it. Or whatever it might be, or I'm working on flipping houses or different things. I would just say, in the midst of that, just keep putting something aside, builds, because things are going to blow up on you. Your business, you thought you were going to sell for, 2 million is going to, vaporize because of some change, or, or a real estate deal you're doing doesn't go the way you thought it was going to go, or those sort of, that's Martin's been through enough life. That's the reality more than the exception, that things don't go the way that you plan on them. But that continual saving, just getting it in, getting it compounding, getting it growing. Those are the people that wind up with the big accounts at the end of life. And it's not necessarily the people that made the most money in their lifetime too, just like what you're talking about. It's that consistent habit. I mean, they may have made it, worked a job that paid them $80,000 a year for most of their career, but they just kept saving, whatever, 15, 20% throughout their lifetime. And at the end, they have a huge retirement account. So that's my encouragement is make it a habit of continually saving, continually doing something rather than waiting for the the windfall to come in. And then you're going to, set a bunch aside.
When Brock was speaking, I was just thinking and Brock, you may have a book that is inspired you at one time or another, or a professor when you were getting your MBA. But one that really hit me when I was a lot younger was The Millionaire Next Door. I don't know if you've read that, Landon, or not, but
I haven't.
it's
I've done the
gold.
compound effect though.
Yeah, the compound effect's good.
Yeah.
But
What was
remember
that book? Millionaire.
The millionaire next door, it was about the guy that worked at Ford Motor Company, and then the neighbor was an attorney or a doctor. And at the end of the day, when they both were 62 and a half, the guy that worked at Ford for 40 years and he made the doctor or the attorney look like a goat herder just from just from being that frugal and just having good habits for those 40 years.
Yeah, we've got to get in a long-term mindset. I think everybody's kind of in that short term. Maybe, it's young folks for sure, but even in real estate, when you go to these doors and they purchased a house 2 years ago and the price they're pitching is, $200,000 higher than what they paid for it 2 years ago. That's how things worked a little bit during the COVID years. We had some crazy times, but that's not normal in life. And even as a young cat myself, I know that, and I think I've even been a little frustrated in the making money overnight type of mentality as opposed to a long-term plan and a long-term mentality.
Yeah.
We usually end with a rapid fire, Brock, but I really wanted to just ask you this. If someone woke up tomorrow and had $500,000 in their account, and I know I just said we got to get in a long-term mindset, not think of 500,000 overnight, but what's the very first thing you'd tell them to do?
It's a good question. I'll be honest, I haven't had someone come to me saying they just stumbled upon 500,000.
Yeah.
But I think that developing a plan for the money questions like how soon do you need that money? How much do you need each year if you're pulling annually, to build a plan that keeps the money that you need in the near term, the next few years, relatively safe and not exposed to market risk. They look at midterm money, invest that a little different, and long-term money is really the key for people to keep outpacing inflation, to make those roughly 10% market returns by having that long-term money invested. So, that's the thing that comes to my mind, is sort of dividing up what do you need in the next 2 to 3 years? What do you need, in 4, 5, 6 years? What do you need in 7 years? Or taking the rest that's going to wait 7 years or longer and investing that, fairly heavily in the market. That's what I think of. Now, I don't sell real estate. When people, if they're interested in putting a real estate component with that and breaking off a piece of that, that's something that I talk about often with clients. They have an idea of how they want to spend this, and then we carve that money off, and really that part of it, I would say, is in the safer side of things. There's a safety in real estate that doesn't exist in the stock market. In the stock market, like in 2001, Landon wasn't around, but in 2001, there were a lot of companies that I was invested in that just went bankrupt. Like they say, hang on to your stocks, and it just keeps going down, down, down. And then the company's out of business and it's worth zero. That's typically not going to happen in a home unless there's something without insurance or whatever. You've always got the home. You can go live in it. Maybe it's, maybe the prices went down, that sort of thing, but you've still got that asset. You're not going to lose that asset somehow. So I think there's a safety that comes in real estate that can play into that mix.
We've been in some training with our title company, Navi Title, and they said that the average Californian that bought during the pandemic, and I think it goes the same for Washington as well, but it was talking about Californians have $600,000 in equity, and the Arizonan has $300,000 in equity. So I took the middle of those two because, obviously you've got to have a house, right? So, taking that out of it. But I was just curious on, if somebody has $500,000 and they aren't utilizing all of that money rather than sitting it in their bank account, I can't imagine that would be the best advice. So I appreciate you taking that on. Martin, do you have any advice? I think we'd tell them to buy real estate, right? But
We would right now in the West
yeah,
Valley. We're down in values the last 12 months. Like I said, some pockets of 8 and 11%. So I've been seeing, this is probably my fifth or sixth shifting market that I've been in the last 20 years here in the West Valley. And this one is, it recovers fairly quick, right? So if we have 4.5 months of inventory, a neutral market is 2 months. Average appreciation is 4 to 6, usually in the West Valley. So you get back down to that average appreciation. You get down to, or right now I should say, we got 4.5 months of inventory. You get down to 2 months. You get down to 2.5 months of inventory. people that are on the fence right now complaining about interest rates at 6%. What's the old saying that the lenders say, Landon? What do? It's a test.
Date the rate, marry the house, date the rate, date the
That's
rate,
right,
marry the
brother.
house.
That's right. You got to marry that house now, because you buy something for 400 grand, it's going to be worth 500 grand. And that's a reality here in another 6 to 8 years. Okay, you can refinance. I mean, you just need to do that.
Snooze, you lose, right? Because I got the same clients from the pandemic that said, well, we're waiting for prices to come down. Now the prices have come down. They're waiting for the rates to come down. They don't work together. I think it's important to listen, to your advisors. I mean, everyone does something for a living, right? And they want to be listened to because they understand what they're doing. Whether you sell cars or you're a financial advisor or you're a real estate consultant, whatever you are, or if you work at the restaurant, right? You know the menu, you know your product, and people want to be listened to, not out of, I know more than you and you need to listen to me. But the reality is when someone does something for a living, 40, 50, 60 hours a week, they get a good grip of what's going on. But Brock, for anyone listening who wants to learn more or reach out, what's the best way for people to get in touch with you?
Yeah, my email is brock.baker@inspireadvisors.com. That's brock.baker@inspireadvisors.com. And my phone number, 623-999-4788. Those are, and then call or text at that number. Those are the most common ways that people can reach out and set up a time to talk.
Perfect. We'll make sure that that's included in the show notes. Brock, we really appreciate you taking the time to join us today. This was a great conversation for anyone trying to be more intentional with their money and diversify. As we've said a lot today, that's the title of the episode. As always, if you found value in this episode, share it with someone who would benefit from it, and be sure to subscribe so you don't miss future conversations. Thanks for listening, and we'll see you next time on Beyond the Sign.